Z Energy, a company that has not seen a shred of light not only this year by posting a massive $88 million loss, but also the many years leading up to it. They have been in constant downtrend for the last 4 years, with the Commerce Commission breathing down their necks trying to regulate the fuel sector, with the investment in Flick Electric in 2018 not going as expected due to changes in the wholesale energy market, and the final nail in the coffin, COVID-19. Is there any light for Z at the end of the tunnel? Will the recent successful $350 million capital raising help them navigate through this tough period? Let's find out right now. Hey, what's up guys? Welcome to another video. Hope everyone's been keeping safe. Just want to give a shout out to this user for suggesting Z. Keep the recommendations coming and smash that like button and subscribe button if you haven't so already. But for now, let's jump right in. So, starting with a small company overview, Z Energy supplies fuel to retail customers and large commercial customers like airlines, trucking companies, mines, shipping companies, and vehicle fleet operators. With over 550 stations across New Zealand, including Caltex and Challenge stations, almost all of the fuel that Z sells in New Zealand comes from overseas. 70% of the fuel is made from crude oil, sourced from the Middle East and Far East. The crude oil is then refined into fuels at New Zealand's only refinery, operated by Refining NZ, which Z has a 15.4% stake in. The remainder 30% is bought from other refineries around the world. Other than that, Z has a 25% stake in Loyalty New Zealand, which run and operate flybys. Z is also the controlling shareholder for Flick Electric, owning 70% of its shares, which they purchased for $46 million. Aside from that, they have the convenience/in-store side of the business, but let's be honest, BP's Wild Bean is way better.
Over the last 4 years, Z Energy's share has dropped from $8.60 to now just $2.70. Despite their revenue increasing considerably from $2.5 billion to $5.5 billion last year, their profits have been in a downtrend. Even before Z was heavily hit by the pandemic, they were already facing challenges in this competitive industry. Although their share price has gone down a lot, it is crucial to find out why it's gone down and get a better insight as to whether it is temporary. So now, let's take a look at the reasons why they have been on a downtrend. In 2018, Z bought 70% stake in Flick Electric for $46 million, which was supposed to be another step towards the long-term sustainability of Z. Flick Electric's one of main strategy was to provide wholesale price to customers with a small margin. This means customers are exposed to the risk of the spot market. However, they can save money by running their appliances when the power price is low. But this didn't go as expected, as the wholesale price of electricity spiked, and so their customers' bill has soared as well. Because of this, their 25,000 customers in 2018 reduced to just 20,000 in 2019. And as a result, they decided to write down $35 million off the value of its stake. And as of 2020, the board acknowledges that the investments into new activities, such as the Flick business, have not been executed effectively.
Reason number 2, the decrease in fuel margins over the last decade. In 2013, Z peaked at a profit margin of 5.5 cents per litre, but now, their profit per litre has fallen 59% to 2.3 cents per litre. There are now 21 retail fuel companies supplying Kiwi consumers that the competitive retail pressure has never been higher. Over the last 2 years, 54 new retail service stations have been built by competitors across New Zealand, and they are all competing on price for volume. A decade ago, there were only about 17 companies supplying Kiwi motorists, and the price discounting was almost unheard of. Over FY20, almost 100% of Z's total fuel volume was discounted. There are now 21 companies competing for customers in the retail market. The fuel industry itself is not one for high margins, which is why stations offer other services such as coffee, food, and more, because all of those sales are high margin sales and can contribute a significant amount to revenue. For example, BP's Wild Bean that is very popular. So when you have heavy competition in an industry that is already low margin based, it can cause a company to crumble, especially competition like Gull, where the fuel is almost always cheaper due to them not having as much overhead cost and being able to sell the fuel at a lower price. But all of this competition brings us to our last reason, the Commerce Commission. In December 2018, the Commerce Commission commenced a market study looking into the factors that may affect competition for supply of retail petrol and diesel used by land transportation throughout New Zealand. After conducting this study for a year, the Commerce Commission came to the conclusion that the fuel companies have been making persistently higher profits over the past decade than would be expected in a workably competitive market. For consumers, this means they are paying higher prices at pumps than could be expected. Z disagrees with the Commerce Commission's profitability analysis because according to Z, the Commission's work was primarily backwards looking from 2018. In our view, it did not sufficiently account for the current market context that has emerged over the last 18 to 24 months. As a result, its assessment of profitability was seriously flawed. At the end of the study, the Commerce Commission provided a list of recommendations to the government to help regulate the fuel market, and unfortunately for the big three, the government has taken the Commerce Commission's recommendations and put it into a bill, which has recently passed the final reading. Bills are rarely rejected at this stage, so it's almost certain that the bill will become law. One of the key components of this bill regulates the wholesale side of things by the introduction of terminal gate pricing in New Zealand. Terminal gate pricing has been implemented to a considerable effect in Australia. Currently, different retailers purchase fuel wholesale from the same terminal at different prices, depending on the individual agreements made by the two parties. With terminal gate pricing, a single price will be posted at each terminal and fuel will be sold. Currently, Z, BP, and Mobil share a joint infrastructure network to supply 90% of the nation's fuel through their own branded retail sites, or via other distributors, or resellers via exclusive long-term wholesale supply contracts. With terminal gate pricing, no retailer is advantaged or disadvantaged. All of a sudden, all the retailers that have been paying a higher price at the terminal due to not having a long-term exclusive supply contract start playing on even grounds with the big three. Furthermore, in the event that the terminal gate pricing fails to lead to a more competitive market, the government will be given price control powers as a backstop. This option is still being investigated, but will be added to the books as an amendment in the future. So without looking at the other components to this bill, the terminal gate pricing itself could potentially impact Z massively by increased level of competition.
Finally, along with all these challenges, Z is now facing unprecedented trading conditions as the economy manages through the COVID-19 crisis. As a result of this, Z is now currently focused on reducing costs and have cancelled their dividends, which they intend to restart in FY22. So if you're getting in Z because of their high dividend yield, don't expect anytime soon. Regarding their FY20 results, Z Energy reported a loss of $88 million. And here you might think, sure, $88 million isn't that bad considering the current situation and the size of the company. But this income statement is for the year ended 31st of March 2020, which means this result consisted only 1 week of level 4 lockdown, which started on 25th of March. For the first quarter of FY21, which is April, May, and June this year, their total volume hit an overall 40% reduction and ended the quarter with $49 million loss, which is more than half of FY20's loss. On the positive side, Z and Caltech's network volume has recovered fast, with Z Network even increasing 8.8% higher compared to last year, which suggests increase in market share. Although it is unfortunate Z has been hit with pandemic while already facing many challenges, Z is in an essential business which is required by any functional society, and the industry won't disappear anytime soon. And with the successful $350 million capital raise providing greater resilience for Z business for the foreseeable future, we are hopeful they can survive through this challenging time. If Z can get through this pandemic and turn this around with better cost management, the outcome may be generous. However, for us, this is not something that we want to take a risk in. The Flick Electric, the low fuel margin, and Commerce Commission challenges are not set of events that can be confirmed temporary. Furthermore, with the rise of electric vehicles and some countries banning or planning to ban sale of petrol and diesel cars by the year 2035, as long-term investors, this does not align with our values for the future outlook of this company.
Hope this video was useful to you and helped you understand whether Z is a buy or a sell for you. As always, keep recommending more and more companies and make sure to smash that like button and subscribe to see the latest analysis on stocks. We'll see you next time.